I need to confess something. My very first investment wasn't in a stock or a fund. It was a pure emotional bet. It was a mistake that cost me 6 months of salary. That mistake taught me the 3 non-negotiables you must set before you even download a trading app. Welcome back to Think Twice, Tony. The world of investing often feels like a VIP room at a casino, right? Full of confusing jargon, high-stakes bets, and promises of instant wealth. That perception is exactly why 90% of new investors quit within the first year, because they treat it like gambling, not like building. Today, we're settling the score. We're going to define what separates smart investing from sheer speculation and walk through the foundational steps you need to take right now. Let's start with the hard truth. Gambling is defined by outcome dependence. You bet $100 and you hope the number generator favors you. The house always has an edge, and the result is short-term, instant, and based purely on chance. Investing, however, is about risk management and expected value. You are analyzing the fundamentals of an asset. You're not hoping for luck. You are expecting a return based on proven growth, like compounding. The key differentiator? Time. Gamblers seek a payout in minutes or hours. True investors measure their success in years and decades. So, if you are buying a stock because you saw a meme about it and hope it goes up tomorrow, you are gambling with investment tools, and you will lose. If you are buying an index fund because you believe in the long-term prosperity of the global economy, that is investing. That is planning. Now that we've made that crucial distinction, let's move to the 3 non-negotiables. Non-negotiable number 1. Define your true risk tolerance. This isn't just saying, "Oh, I'm okay with a little risk." You need to mentally and financially survive a 20% market crash. Imagine you've put $10,000 into the market, and 6 months later, it's worth $8,000. Would you panic and sell everything, locking in the loss? Or would you calmly see it as a buying opportunity? If the thought of a significant temporary loss makes you sick, you are low risk. If you're low risk, your investments should heavily favor bonds, CDs, and safer diversified index funds. If you're young, have a stable job, and can afford to ignore your portfolio for years, you can afford higher risk. This determination dictates your entire portfolio allocation strategy. Get this wrong, and you will panic at the worst possible time. Non-negotiable number 2. Define your time horizon. Money you need in the next 5 years does not belong in the stock market, period. This includes down payments, tuition costs, or scheduled major car purchases. Investing is most effective when your target is 10 years or more away. Why? Because market volatility smooths out over time. If your goal is retirement 30 years from now, you welcome short-term dips. They allow you to buy low. If you need the money in 3 years, that dip could destroy your savings just when you need them. Are you investing for short-term gains, medium-term goals, or long-term wealth transfer? The answer dictates whether you choose safe cash accounts, moderate bond allocations, or aggressive equity positions. Non-negotiable number 3. Define clear, measurable goals. Investing without a goal is like driving without a destination. You're just burning fuel. Your goal should not be rich. Your goal should be, I need $50,000 for a down payment in 7 years. Or, I need to generate $4,000 a month in retirement income 25 years from now. These specific numbers allow you to calculate the realistic rate of return you need. This calculation grounds your expectations in reality, preventing you from chasing impossible 1,000% returns. If you have a clear goal, the next market dip becomes a metric check, not a personal failure. Remember, risk tolerance, time horizon, and specific goals. You must write these down before step 1. So, you've set your 3 non-negotiables. What is the actual first action item? It's not opening a brokerage account. It's analyzing your current money situation. Step 1, get rid of high-interest debt. That 20% interest rate on your credit card is the single worst investment return you can get. Pay that off first. It's a guaranteed 20% return on capital. Step 2, build an emergency fund. You need 3 to 6 months of living expenses liquid, accessible, and totally separate from your investment pool. If you lose your job and have to pull money out of the market, you might be forced to sell low. The emergency fund prevents this cardinal sin of investing. Step 3. Start small and start simply. Your first few investments should be low-cost, broadly diversified index funds like the S&P 500. Forget the individual stocks for now. They require deep research and significantly higher risk. Index funds allow you to participate in the general growth of the economy without trying to outsmart it. Remember, consistency over complexity. Time in the market beats timing the market. Investing is not gambling when it is built on analysis, patience, and defined parameters. Gambling is hoping. Investing is planning. My mistake cost me a hefty sum, but it bought me an invaluable education. If you skip those 3 non-negotiables, risk, time, and goals, you are rolling the dice. If you set them, you are charting a course. Before you fund that first account, sit down and write out your tolerance, your horizon, and your exact numerical goal. Let me know in the comments, what is your biggest financial goal right now? Hit the like button if this helped you shift your mindset from gambler to investor, and subscribe for more deep dives into building lasting wealth, not instant hype. Thank you for thinking twice with Tony. I'll see you next time.